You've heard it a million times: start early, invest regularly, and let compounding do the rest. But here's the truth: SIP and lump sum investing won't make you rich unless you do one thing first. This video is about the missing piece, the reason most people invest for years and still feel broke. If you're serious about building real wealth, not just watching numbers on a screen, then this is the wake-up call you've been waiting for. Stay with me, because once you understand this, compounding will finally work in your favor, not against your timeline. Why SIP and lump sum compounding only works if you do this first. Compounding is called the eighth wonder of the world, but here's the truth no one's telling you: systematic investment plans, SIPs, and lump sum investing won't make you wealthy unless you do one crucial thing first. It doesn't matter how consistent you are or how early you start. If you skip this one step, even the best compounding strategy will underperform. So what's this missing link? It's increasing your income and free cash flow first. Let's break this down. Downward trend: why most SIP and lump sum investments disappoint. Imagine this: you start a SIP of $100 a month. You stay disciplined, invest every month, and believe in the power of compounding. After 10 years, your portfolio grows, but not to life-changing wealth. Why? Because you were investing too little for too long, expecting too much in return. Even at 12% annual returns, $100 per month only grows to around $23,000 in 10 years. That's great, but not financial freedom. The same goes for lump sum investing. Let's say you invest $5,000 once and wait 15 years. It might grow to $25,000 to $30,000. Nice? Sure. Life-changing? Not even close. The harsh truth is, compounding rewards volume. Without significant capital to work with, the magic is painfully slow. Key: what you must do first: increase income plus investable surplus. Before you rely on compounding, you need to create financial fuel. That means increasing your active income, reducing unnecessary expenses, creating a large surplus that can be consistently invested. This is what the wealthy do. They don't start small and wait 30 years. They build high-income streams fast so they can invest bigger chunks, early and often. Pushpin: think of compounding like fire. Small twigs equals small fire, big logs equals roaring blades. Compounding is exponential, yes, but it's only exponential after a certain threshold. Below that, it's just slow. Brain: the psychology of compounding. Why most people quit. Most people stop SIPs or avoid investing consistently because they don't see results. But that's because they expect fast growth from small investments, don't understand that compounding accelerates after 7 to 10 years, haven't yet built the financial muscle to invest more. In reality, compounding works like a hockey stick. Years 1 to 7. Almost flat. Years 8 to 15. Noticeable growth. Years 20 plus. Explosive rise. If the capital was meaningful, but if you've only been investing $100 per month, even 30 years later, the result is modest. That's why the key is to increase your investable amount over time, which means improving your earning power. Flying money: how the wealthy use compounding differently. Rich people don't wait for 30 years to see wealth grow. Here's what they do differently: create high income first, business, skill leverage, or investing in themselves. Cut lifestyle inflation. They control expenses while income rises. Deploy big capital early: $10,000, $50,000, even $100,000 in smart investments. Use compounding with scale. Once the base is large, compounding works fast. They don't rely on SIPs of $100 per month. They move cash, real estate, stocks, and equity across income-generating assets, and let large sums compound with minimal effort. The average person can follow the same path, but it requires a mindset shift. You don't start with investing. You start with increasing your capacity to invest. Bar graph: how to make compounding actually work for you. Here's a simple 3-phase strategy to make SIP and lump sum investing actually work. Phase 1. Build financial capacity, 0 to 12 months. Increase your income through side hustles, promotions, high-income skills. Cut back on lifestyle upgrades to build cash reserve. Set a target, e.g., I will grow my monthly investable income from $100 to $500 in 12 months. Phase 2. Accelerated investing, 1 to 3 years. Start SIPs with your growing surplus. Add periodic lump sum investments from bonuses or side income. Diversify. Mix mutual funds, index funds, ETFs, and write phase 3. Let scale multiply, 3 to 10 plus years. Increase investment size as income rises. Let compounding take over while you focus on new income streams. Use long-term vehicles like equity mutual funds or stocks with strong fundamentals. In this method, compounding becomes the second engine, not the first. Your income growth is what fuels it. Prohibited the dangerous myth of, start small, get rich. It's often said, just start with what you have. Even $5 a day is enough. Yes, that's a good starting habit, but don't mistake habit for wealth generation. Starting small is good for discipline, but scaling up fast is what brings results. If you're earning $1,500 per month and investing $50 per month, you're making a smart choice. But your real goal should be, how do I earn $3,000 per month and invest $500 per month consistently? If you never increase your earning power, compounding remains weak. Even 20% annual returns on small capital equals small outcome. Abacus example. Small versus scaled investing. Monthly investment years return, 12%. Page A. Final amount $100 per month, $10, $23,000. Small impact $500 per month, $10, $115,000. Noticeable growth $1,000 per month, $10, $230,000 plus. Life changing $5,000 one time plus $1,000 per month, $15, $450,000 plus. Real wealth building. The bottom line: the earlier you scale your investments, the sooner compounding works with visible results. Checkmark summary. What you must do first if you want SIPs and lump sum investing to change your life: do this first. Increase your income. Focus on growing skills, business, or career. Create consistent surplus. Control expenses. Automate saving. Scale your investments early. Move from $100 per month to $500 plus per month as fast as possible. Then let compounding take over. Once capital is meaningful, time does the heavy lifting. Compounding isn't a magic trick. It's a powerful multiplier of what you feed into it. If you feed it crumbs, it multiplies crumbs. If you feed it surplus, consistency, and time, it gives you freedom. Start small, yes, but scale fast. That's the only way SIPs and lump sum compounding truly work. Remember, compounding isn't magic, it's a multiplier. If you're only feeding it crumbs, don't expect a feast. The real game starts not when you invest, but when you increase what you can invest. Bell. If this opened your eyes, make sure to like, comment, and subscribe, because we're breaking down the money myths they never taught you. Bullseye. Want more videos that show you how the rich actually build wealth? Hit the bell and join the journey. See you in the next one.